Hello, my name is Jody Samuels, and welcome to the Global Market Analysis for June 17, 2016, an overview of key markets. It was a wild week in the financial markets as investors embraced a series of central bank decisions with the majority of the focus on Janet Yellen and the Fed. After a strong sell-off to start the week, the S&P 500 cut the majority of its losses to settle the week down roughly 13 points at 2,076. Similarly, crude oil prices declined $1.46 a barrel from the open on Monday, but also reversed towards the end of the week, remaining well below the critical $50 level at 47.10. The US dollar, on the other hand, using the euro as a proxy, traded pretty well flat for the week, with gold gaining about $4 an ounce and 10-year Treasury yields finishing the week down 3 basis points to 1.61%. On the U.S. economy, the biggest news item came out of the much-anticipated FOMC meeting, where the Federal Reserve left rates unchanged at a target range of 0.25% to 0.50%. Although the statement showed an acknowledgement of a slower labor market, the Fed also noted that economic activity was progressing well. More importantly, the dot plot suggests that officials still expect to increase rates twice over the next 6 months. In addition, a significant factor for Janet Yellen was the UK referendum that is set to take place next week on June 23rd, where a Brexit would surely have a negative global impact. The US dollar had initially sold off following the rate announcement, but managed to rally strongly into Thursday morning. We continue to show this chart, the daily chart of the euro, with the market overlays of oil, the S&P, and gold, because this chart shows how these markets have continued to correlate since January of 2016, or this year. An intermarket analysis is key to understanding what is driving markets, and at any point in time, there are different drivers. Currently, the key drivers are U.S. economic activity and when the Fed will raise rates. The relationships to observe are the inverse relationship between gold and the dollar, and the positive correlation between oil and the S&P. And the key is to follow these relationships during the trading week to get clues about your traded market. Let's move on to the European markets. Ongoing concerns continued this week with regards to a potential Brexit, which led to an awful lot of volatility across global markets. The most recent survey showed that 55% were in favor of leaving the EU, compared to 45% who wanted to stay. As a result of the uncertainty surrounding the referendum, investors have been pouring money into safe havens such as the German Bund, while European stocks reached a 4-month low. Global markets saw a huge reversal Thursday morning following the tragic death of UK Labour Party lawmaker Joe Cox, which caused all referendum campaigns to be suspended, giving hope of a possible disruption to the June 23rd voting. As a result, the British pound rallied from a low of 140.12 to end the week at 142.89, and the euro saw a sharp reversal at 111.32, trading higher to close the week at 112.58. From an Elliott wave perspective, the euro has been trading in a broad trading range since March 2015, so more than a year ago, between the high of 117.16 to a low of 104.70. And this consolidation is called a complex sideways correction in Elliott wave lingo. In the more immediate term, since March of this year, the euro has traded between 116.16 and 108.20. But in the shorter term, since May, the support has moved up to 110.98. So call that the range, 110.98 on the low side, and in the short term, on the high side at 113.03, which is this week's high. So for this week, expect the euro to test higher levels if 113.03 is taken out. Otherwise, trade this week's range. Moving along to crude oil, the price of oil once again failed to settle above $50 a barrel. as some downward pressure was seen to refrain more producers from entering the market. This comes after oil rigs for the prior 2 weeks managed to rise by 12 to 328. That may provide a sign that U.S. output could stage a comeback. On a similar note, the IEA on Tuesday stated the surplus has been shrinking faster than expected due to increased demand and is therefore predicting a balance by next year. Furthermore, news that Iran is expected to increase output by 600 to 700,000 barrels per day over 5 years and the re-emergence of Canadian output this month also prevented prices from rallying. With that said, the EIA showed that crude stockpiles fell by 933,000 last week, which caused prices to trade higher near $49 before tanking to a weekly low of $45.89. From our Elliott Wave perspective, look for a retracement of this strong close of the week and a subsequent move higher. The price of gold bounced slightly for the week as capital inflows persisted once again, given the uncertainty regarding Brexit. The potential for the Fed to maintain interest rates lower for a longer period than initially expected has been bullish for gold. Gold had spiked higher following the Fed's decision to an 18-month high of $1,315 before tumbling almost $40 an ounce following the UK shooting to trade near the lows of the week. And finally, the S&P. The S&P for the second straight week saw a strong move down after breaching the significant 2100 level. Although prices had initially saw a bounce as the Fed kept rates unchanged, the index started dropping throughout Yellen's post-press conference. Investors recognized the dovishness of the Fed's statement due to slower growth and how a Brexit would only worsen the global economic situation. So equities continued to decline overnight following the BOJ's decision to maintain their current monetary policy stance and measure the impact of their negative interest rate policy. Nonetheless, the S&P saw a huge bounce back following the unfortunate shooting of UK MP Joe Cox, as prices traded 40 points higher from a low of 20.50. From a Fibonacci perspective, the S&P retraced almost 78.6% of the last swing move, and unless the S&P breaks down through 2050 next week, expect consolidation and a retest of at least 2100. Have a great trading week. See you next week. And thank you very much. And if you enjoyed this video, please like and subscribe.